Hey folks, I'm going to do a bit of an educational video. So one thing I have been noticing with some of the communities that I'm in, and just in general, I think could be a common thing for anybody starting trading is to struggle with FOMO, to struggle with trying to figure out how to capitalize on days where the market will trend. I see, and I've also done myself where you'll try to call tops on trending days, or you'll just overtrade, try to find an entry, and ultimately just become frustrated. You get chopped up. You come back towards the end of the day with hindsight and see, wow, if I would have just held, or if I wouldn't have tried to short but went long, or if it's a trending short day, if I would have quit trying to go long and just went short at this particular spot, I would have made X amount, whatever, and just spend the rest of the time beating yourself up. So, not that I'm an expert or anything of that nature, but certainly had my fair share of struggles. And so I just aim to give back in some way if I can. So, what I try to teach with the market internals and why I find them so important in trading is because, personally, from my journey and from my experiences, that what you really need in order to be successful with trading is you need consistency. And everybody says that, but I don't know that to a large degree, the material I have found is nobody really says in what ways you need to be consistent or what is a good way to be consistent. And I'm not saying you can't be consistent with something other than market internals, but this is what speaks to me because I don't just like to say enter a trade because two moving averages crossed or the RSI is this or that. Um, for me, a lot of it is structure of price, but it's also the journey that price made to arrive where it did. I think I've said it in past videos that take, for example, SPY's price of 450. Maybe it reaches 450 one day. 3 months from now, it reaches 450 again. It's not the same 450. There's a reason it's at 450 again, or there's a reason it was at 450 the first time. So the way market internals assist me is it gives me the context of why SPY is back at 450 or why it's at 443 or whatever else. It's one thing to have a price level on your chart because you see a wick from daily time frame or weekly time frame, but to me that's still not necessarily enough. There needs to be a reason why that price, that particular wick, is important. Now, yes, sometimes time frames have an importance because of potentially the size of the participant that is trading from weekly, from the monthly, from the daily time frames. That being said, it's more and more apparent that even the big participants in the market are trading things like 0 days. They comprise the highest volume options traffic. So, what you need to be consistent is, yes, you need consistent risk management, but you also need consistent reasoning for entering the markets. You need to be able to measure the market in a consistent way. And you can do this with anything. I'm going to explain how I do it with market internals. There's a myriad of ways to do it. But the thing that I will say that I find to be vastly important is using something like standard deviations, at the very least a fib tool. And you don't even need to use like the Fibonacci golden pockets or anything like that, but just the power of being able to trace out a range high to low and have that midpoint, have that midpoint on your charts 50%. Even that is important. So with all of that out of the way, how I trade with the trending days, where I think most people beat themselves up with hindsight, is, oh man, I could have made this much money. You need to understand a very basic thing, and that is simply the day's range, previous day's range, or the current day's range, and then reference it the next day. On this day here, August 28th, we held Friday's high price all day. The fact that we did not close lower says the buyers have accepted this price, or the market controllers are enforcing this price. They're panicking, the short side, however, whatever narrative you want to use, it doesn't matter. The point is the price held above this weekend, Friday, that high price, right? You see something like that, you see a breakout of a previous daily candle or whatever time frame you want to use. That is a statement that you should be mindful of. So having that the day prior, we're coming into this day. Once we break this high, that even just the structure, you don't need TWAP or anything else. We break that high from the day that held that price, and we have a retest here. Now this is where I go to the market internals, and I want to look at, what day is this? August 29th. The first thing I'm curious about is, where is the entire market at? I've said to people in personal conversations that, and I think the very first video on this channel is, the New York Stock Exchange is literally the wind in your sails for when you're making a trade on an index ETF. If the entire market is not behind you, your trade most likely will not work out. Unless there's some severe divergence for some reason within that particular sector, whether it be the Dow, the Russ, the tech sector, or the spiders, it's not going to work if the whole market is selling off and you're trying to buy the dip on SPY. You will get steamrolled. I know, because I've done it. Before I had the context, I did it often, trying to call bottoms. So on this day, we see that the midpoint of the entire market, the balance area of volume, it's sitting at the midpoint. It hasn't picked a side yet. We start to see an uptrend by 10 o'clock. By 11:30, we are in a very strong bullish area. Now, you do not need to wait for this, but this helps. Once we've cleared this area, this is very helpful. This is a great signal. And by 11:30, there's still plenty of time left in the day. If you go look at 11:30, where are we at on SPY? So on SPY, we've already moved. Now, this is an extreme example, but we've already moved $5. So you think, well, can't possibly extract much more out of that. This would definitely be considered a chase kind of trade, to enter long up here. That would be true if this were a range day. But we already had a break of a high price the day prior, and we've already done it again here today. You can take advantage of these days just by simply having a consistent way to measure the market. That's what you need. You need to be able to measure the market. Once you can consistently measure the market, then you can consistently size your risk, and you can trade. You can enter in all different kinds of places, and I'm sure people will probably disagree. And to a point, entering at the high of day is really dumb. That's why you wait for a pullback. You have to understand where the pullbacks are, and that's where I have more market internal tools that I use to understand where a continuation entry for a trending day is potentially a high probability trade. So 11:30, we're here. What did we see? We're making consistent higher lows all the time. We get this melt up, we make a new high after a little bit of a retracement, but we held this low and we held that low. So this is a very good entry, which sounds nuts. Now, where would you put your stop? You can turn on all different kinds of tools. This happens to be a first standard deviation break and retest entry. I've made a video about this very thing. This is exactly the entry right here. You get in here, you set your stop loss. Depending on your comfort level, you can use price structure if you'd like. You can keep your risk tighter if you like. Below this pivot. And then what do you target? Well, from the time you enter, you can draw lines from the standard deviation levels at the time of entry. And you drag your tool out and you make your trims based on those levels. So you get a trim here and you get a trim here. You can hold this the entire day. Eventually your stop loss, which is TWAP if you're using that, actually is in the profits. So it's a no risk trade. Okay. Now the other factors to understand whether or not this is a trending day. So you go look at, we already looked at the volume. Let's go look at the ad. What is the ad doing on this day? So here it's on a balance right out of the gate. Okay, typically on a real strong trending day, you want to see ad already close to 1500 positive or negative for a short side. We didn't have that this day. We had a zero breakdown test, balance, and then we ripped. Now, here's the other important thing is 11:30, same thing. Volume and price are mostly in sync. And then look, we're in here and we never left the whole day. So this, once you see ad, the entire price of New York stock, the New York Stock Exchange, once you see it in here, that is very much a very strong advancing market. The entire market, you can go pull up probably any stock and it's ripping. I don't care what it is. So when you see that, obviously if it's over here, we only got an hour left, probably too late. You want to see it early in the morning session, definitely before lunch is preferable, so you can get in before the stupid lunch slump. But once you see this is a high confidence trending day. Now, typically trending days get going at the first hour of the day or sooner. So this is definitely more of a rare day. All right, so you can get in here and you have no problems. Your entry price was never tested for literally the rest of the day. I think most people would say that's a pretty good trade. Now, let's say you missed this. Okay, well, go pull up an old day where you missed, you're beating yourself up in hindsight instead of looking for how you could have traded that. Are there factors, are there measurements, are there things you could have known that would have helped you say, oh, this dump here actually was a great entry? All right, well, yeah, in a sea of bullish tick, right, we had one little tiny pullback here on tick, and we already know per the ad and VOLD, the price and volume of the market, that this is a high probability this is a trending day. So now we're just focused on continuation entries, not short reversal entries. That's it. I can make a different video for that, but today I'm just doing this. So here, right, you can buy the bottom of this candle here, this downward candle. It's right at this particular pivot. And what's fantastic about this is if you're wrong, your stop is really tiny compared to your reward. And that's all it is. There isn't anything else to it at the end. There is nothing else to it. It's keeping your risk logically placed such that it is smaller than the reward you collect. And you have to have a reason. It can't just be you're bored or this looks good. No, it has to be something consistent, something measurable, something scientific. So you get in here. Or we've got downward tick closures. We've got more bear ticks here. But look at this. It's still a higher low from this entry and definitely from this entry. So maybe you missed this one. Maybe you missed this one down here. We'll get in here. And you say, oh, well, there's so many bear candles here. It's selling off. No, it's not. These are just fake outs and other garbage the market makers use to trick people while they're piling in the volume across the entire dang market. Price is still in advancement. It cools off around 2 o'clock, but it's still going. And it's still above TWAP. So a lot of times too, if you're using TWAP, above TWAP is bullish, below TWAP is bearish. It's just a really simple way to read that. It's not much different than using VWAP. If you're over VWAP, bullish. If you're under VWAP, bearish. Now, there are times where that's not true. I'm not saying that's like 100% true all the time, but it's just a very easy way to remember it. Trending days. Can't say that enough. I'm talking about trending days. So now, where do you take profits if you're not using, if you don't want to use these? Okay. Well, sorry to say, I'm going to go back to monthly TWAP. So monthly TWAP, this is another great tool, and I'm sure you could use VWAP for very similar. They're not. This does not use volume, but VWAP can be quite similar. So you want to look at from a monthly perspective. This is still 2-minute resolution, but it's a monthly distribution for this measurement for TWAP. You want to look at how price is reacting to the various deviations. So here's the first deviation, second, third. We already know on this month of August 2023, we already know we hit third. We reclaimed, right? We started to make an upward trend here. Now we did reject from, I think this was the NVIDIA earnings, we rejected the monthly mean price. But even though we broke first standard deviation low, back into second, we made another attempt at reclaim. And then here's that day where we had that high price. Now, Tuesday, the day we've been reviewing, this is where we have a break and hold. We retest and break over the monthly TWAP, and then we hold it. That's a fantastic signal, right? So let's say you're in from, what time was that? 11:30-ish. So 11:30. Where's 11:30 on here? Okay. All right, so 11:30. So not only was that a session-based TWAP entry, it's also a monthly TWAP level. I've got a little box around here. So where would your targets be? Well, your ultimate target, I think, would be mostly around this price right here. This is a monthly TWAP level 448. Now, typically, if you're already in from lower, maybe you called a trending day earlier based on other factors, you can use this level, this level, this level. These levels are just based on standard deviation and monthly mean price. If you don't like monthly TWAP, or for whatever reason you don't want to use it, let's see here. You could use, what else could you use? Let's look at the fib tool here for extension. It's a free tool built right into TradingView and many other many other charting softwares. Now look at this. Now all I did was draw from the low to the high, and this creates just very basic 0.5 based extension levels. Look at how beautiful the price reacts to all of these. This is incredible. I mean, here and here, it's different than the TWAP levels, but it's still basically the same thing. So maybe you would have entered a little bit earlier here. Then you've got 1, 2, different targets that you could have used. All right. And you don't have to use TWAP, you don't have to use market internals, but like I said, you want to have some kind of context to why you think the market is trending today. And personally, the data of the entire market is, in my opinion, one of the single most important factors in assessing what kind of market you're trading. The market changes every day, and you need something to measure in order to make that determination. You're not going to get that from you're not really going to get that from an EMA, an exponential moving average, or any other moving average. Those are all great in creating a supporting narrative, but it's not real data other than just the price itself. It doesn't tell you, oh, the entire New York Stock Exchange increased by some amount of volume that day. So this is a really great setup for how to figure out what is the probability of a trending day. And you can figure it out real early if you're using, you don't have to use any EMA indicators. I'm not trying to convince anybody to use them, but you should be looking at VOLD, the volume of the market. You should be looking at, in my opinion, you should be looking at ADD, the price of the market. Those two things alone will, I feel like they'll make you a better trader. Uh, Same thing here for Wednesday, the 30th. This is when I'm recording this. We never entered the strong bull zone. So there was never any reason to think trending day today. Same thing for the volume. The volume never entered the strong bull zone. Therefore, no reason to think there's a trending day. This day here, this got off to a late start around 12:50 on the 24th. Let's go look at the 24th. What did the 24th give us here? Gee, this looks like a trending short day. I wonder if there was an easy to spot trade. So let's look at, we obviously know we're headed down since we can't hold 0 point of volume. We see the direction, even if you waited until 1 o'clock, which if you watch my review videos, you know 1 o'clock is one of my, close to one of my favorite times. I like the 1:30 time. So here's 1 o'clock. What were we doing around 1 o'clock? Looks like we were rejecting the TWAP, which again you don't have to use. You can go look at anything else. But yeah, we're rejecting previous important structure. See if I can find my rectangle tool. So we've got this little low. We're retesting that, right? Even if you don't use these TWAP levels, you don't have to use them. Okay. Turn all that off. This is real chop, but it's significant structure. It's also an attempt at previous day's midpoint price. So that's another important kind of measurement, the high, the low, and the midpoint. We couldn't even reclaim this little chunk of BS candles here. We couldn't reclaim mid. Boom, it's right towards short. Where's your profit target potentially? Right, you could say your stop loss somewhere around here if you like, and you grab the just even the low price. That's a 2 to 1 trade there, right? Yeah, and it's a $1.20. And if you are somebody that's using TWAP, well, look at what we got down here. We've got a TWAP price target level, so it's a little bit before the low. We also got this one down here. Did we hit it? Well, yeah, we sure did. 4 to 1 trade. Or if you stretch your SL out to the TWAP, it's a 2 to almost 3 to 1 trade. So that's just really simple, right? And you can have confidence even though we've already dumped almost $6. Right? We did do a retracement of about $1.60 something. You can be confident that it's a good probability. It is not crazy to enter there because of where the volume is, because of where the price is, right? Price is significantly in decline. Now, it's not the strong bear zone that I would like to see, but overall, the trend is good for the downside, and the volume is in the bear zone. The volume is the leading indicator of the two between add and volt. So I would encourage you to find ways to measure the market consistently. There are trades almost every day, and I've mentioned the times in my market internal review videos. Go listen to some of those. 1:30, 12:30. Look at when other regional markets close, the European markets, the Asia markets. Those are all important times to know. The pre-market high and low, those are important. Those are all ways to consistently measure the market. That's all you need. You don't have to use market internals. That's just what I use. You can find trades like this, no problem, all the time. You just have to be patient. You have to know when to size, how to size, where to risk, where not to risk. But as long as you consistently measure the markets and your system is consistent, your discipline will follow. You just have to develop that system. If you continue at it, you should find success. At least I know a handful of people that have, following some of the same advice, where you just have to have a consistent way of measuring the markets. It doesn't have to be anything fancy. For a lot of people, probably the most simple ways of measuring are probably best. Just speaking with some folks about trying to find a way to make internals work, or just how to risk correctly, and how to find the trade entries. And just, I don't want to see anybody beat themselves up. I don't like seeing people struggle with consistency, and especially with, in my opinion, what I consider to be pretty nice tools with the market internals, and just the ease of which they've afforded me to assemble a clear picture of the markets, and not just a candle that's here, but why is it here? Why should I get in here versus here or up here? And yeah, that's pretty much it in a nutshell. I don't know how many of these videos I'll do, but I'm going to try to hone in on just trade strategies, how to, or what I find to be important, such as consistently measuring the markets. And I'm going to try to release a couple of older recordings, or maybe I'll just re-record them for how to use these indicators in more of an isolated manner. So TWAP in itself, these price target levels are absolutely phenomenal. Every day I see price responding, to these levels almost to the cent, just all the time, and just all the time, and they just constantly reaffirm my belief that I don't really need anything else. And that's really what you need to, is you just need something that works, because you see it. You see it work all the time, and it affirms your belief in what you're measuring is accurate, and is providing the real context. If you're somebody that's constantly switching strategies, it could be a mixture of desperation, it could be a mixture of disbelief in whatever it is you're currently looking at, or and maybe it is successful, but you don't try it enough, so you can't do the work, because you keep switching strategies, you keep switching analysis methods, measuring methods, and you can't do that. You have to stay consistent, but you do have to use something successful, right? Like, I always see people say, "Oh, well, just make sure, if you're losing a lot of money, Well, just make sure you're using a stop loss. And that's great and all. Stop losses, are definitely fantastic if you're doing something like what I suggested, where you have a consistent way of measuring the market. It's based in real data, okay? But if you're shorting a market that's trending up and there's no reason to be shorting it, and you're using a stop loss, like maybe you short here, you get stopped out. Maybe you short again here, you get stopped out. Maybe you try shorting here, you got stopped out. You try shorting here, you got stopped out. And you just think, oh, well, I'm using stop losses, so I'm doing it right. Well, no, you're not. Because even though you're using a stop loss, which is good because you're not going to lose all of your money at once, but you're going to lose it over they call it death by 1,000 cuts. It's because you've gotten something wrong. Your understanding is incorrect and you're not assessing things correctly, which is partly why I think people say you need discipline and you need to be able to walk away. And that's all true. But if you just walk away and you never come back to look at things, you'll never figure it out. So that's where I'm a little bit more stubborn, maybe, and I'll continue to sit there, maybe not trade, but I'll keep trying to figure out what it is I'm missing. And these markets can be very tricky. You have to know too things like when we've ripped like this, what's the probability of more ripping the next day? Probably not much. So that's the other thing. Just having a couple key areas of context of where are we at within the week? Did we just start the week? Are we halfway through? What's the probability of the low or the high being made for the week or the month? Just depends on your time frames, but those are all very important things, and it's all back to how do you measure the markets. So all all you have to do is figure out how to consistently measure the markets. You don't need anything else. Once you have that, then it's just about finding those patterns, finding the reasoning for entry, and not just, in my opinion, anyways, not just some candlestick pattern, but real data, a real reason. And once you have that, then you've already got the measurement of where you should place your stop and where your profit should be. And then the rest of it is just be willing to either have enough in the trade such that you can trim off some as your profit targets are hit and you still have some on the table, or if you say only have like one contract, then you must have the discipline and the patience to just hold it to your final profit target. Maybe you have a rule that says if you get in here and your stop loss is down here, once SPY has reached so many of my profit targets that if I had more contracts I would have trimmed already, I'll move my stop loss on my single contract into profits. That way, no matter what, you're not losing money. But those are all rules and part of a system that you should be developing, not just blindly YOLO trading or using stop losses and going short on a long trending day and just getting chopped up. That's not going to help you. So, but yeah, I mean, even just a simple fib extension tool will give you a really good edge. You can see how well, for whatever reason, yesterday, or not yesterday, but the Monday, the 28th range, for some reason, right, works as a fantastic scalping range for Tuesday, the 29th. And why is it that way? I don't know. Maybe it's all the algorithms that trade the markets are using 50% levels, which is all this is. I've yacked enough. Hopefully you found this helpful. If you did, feel free to leave a comment, and or if you got questions, leave a question down in the comments, or you can hit me up on Twitter/X. If you find this content interesting, I guess leave me a comment and let me know if you want more of it. Thanks for watching.